Obviously, I came across you when I saw your Ask Me Anything on r/superstunk on Reddit, and I was just enthralled at some of the stuff you were saying, and wanted the opportunity to speak to you to myself. So I'm really pleased that I get to do this. So I'm just going to dive straight into the questions I've prepared, so we get as much time or as much out of the time as possible. So in another one of the Ask Me Anythings, I saw Wes Christensen and Dave Lahr talking about numerous occasions in history where the short interest or short interest or the number of shareholders that voted on a company in a shareholders meeting was over 100%, and some occasions that they were quoting were well over 200%. Um, what why has nothing been done about that yet? That seems like a huge thing that should probably be addressed.
Well, yes, and and I mentioned in my previous interview that in the around the 2007 2008 when we had the financial crash and people were selling financial industry stocks short like crazy, the SEC did step in. They put in some temporary regulations. They passed a rule just before that was called, it's still in force, okay, and it's a Reg SHO, and it was designed to make the short interest more transparent to people. And so they did a few things. And then when the financial crisis hit, they passed some temporary regulations. For example, they forbade people to sell short certain banks, and certain financial institutions because they were putting them right into the dumper. I mean, some of the biggest banks in the world could have crashed because of these short sellers selling constantly shares that truly didn't even exist. They just kept selling, selling, selling into the market. So they did that. And then they took a breath. And in 2009, I mentioned this the other day, the inspector general for the SEC of audits did it must be a 50-page survey, and they said, yes, we're not monitoring these things closely, we should monitor them better, and we should open cases and track them until they're resolved. And well, what happened, and actually Suzanne Trimbath mentioned this in her uh, podcast too. That was a time when everybody was looking at risk in terms of the that day's market value. So they would track the gigantic items, but the thousands and thousands of small items would somehow just get lost in the shuffle and get ignored. And so they made 11 recommendations, and the SEC only adopted one, if you could believe that. And then since then, I've written to them, my God, they must be sick of hearing from me. I keep writing to them and saying, you must fix the abuses in short selling, mainly because back then we weren't seeing what we've been seeing this year, okay, and the end of last year, but we were seeing overvoting, massive overvoting, and you didn't know whether the real voters were getting their votes in or fake people were getting their votes in. So we've written to them numerous times. Public companies have written as well, and I guess it wasn't such a big problem. Well, this year, of course, it's becoming a much, much bigger problem. And short selling, too, it tends to be cyclical and it comes to go in waves. And there's actually another reason where short selling's kind of abated. And that is that a lot of the most active investors and the biggest plungers and gamblers, okay, they found a better way to make money, which was to put companies themselves into play, to take them over, to take over the board, to put the company up for sale, to merge with another company. And so you could make more money taking apart companies or selling them or merging them than you could, and in fact, which always made the price go up. So it became a lot riskier to be a short seller when you had activist investors who were basically auctioning the whole company off. The whole company was up for grabs there. So that kind of made the short sellers go quiet, relatively quiet, until what we are seeing today with the so-called meme stocks. And so now is a different day, and so this is very timely, and it's time to be getting down to cases and fixing this. Okay.
Hmm.
So that's a long answer to a short question, but that's my answer.
No, that's all right. I mean, this is the beauty of the format, is that you can take as long as you like to say whatever is required. And
You may don't say that. You may regret it.
I no, I doubt it. Don't worry.
Okay.
So, talking about the 11 recommendations that you mentioned that were made to the SEC, was warnings about problems with failure to delivers and things like that. And you said that they only have one recommendation put in place, and that was only temporary, as far as I'm aware. Now, I,
But most of these regulations were temporary,
hmm,
okay? And so I think your question is about fails to deliver and I guess the harm they do. So I guess we should start with the fact that fails to deliver are just a fact of life. Every day there are fails to deliver, and Suzanne covered this too. There could be a lot of reasons: missing a bit of information, the wrong broker, the name, you deliver the wrong stock, and it doesn't match the CUSIP number. So most times, it's a bookkeeping mistake that creates fails to deliver, and they're there every day. And as Suzanne described too, they check them off, they resolve them, and most of the times they get them fixed. But when they arise from naked short sales, and when the naked short sales start to pile up, so that they're not just 50% of the outstanding shares, but 100 or 150 or 200%, well, now fails to deliver are a huge problem because people have sold all of those shares, but they didn't deliver them. And so there's liability. And guess what? Where do you get the money? Okay. Until you can get the shares and sell the shares and give the money back or give the shares back, you've got enormous liability. So now suddenly, with what's happened late last year into this year, the fails became a gigantic problem. And so DTC, for example, quite properly went to what's their name there? Oh golly, yeah, Robin Hood, and said you got to put up 150 million of collateral or something because they had open trades that weren't settled that were on the order of 150 million dollars worth and maybe more. And so when fails to deliver get totally out of hand, as they did several times this year, they became tremendously risky to the financial system as a whole. And it's actually similar to what happened with that quasi bank there that lent all that money and then lost track of it all. So that's why fails are a problem and why people need to track how big that problem is. And when it starts to get into super large dollar values of failed deliveries, there's risk to the entire financial system. Because remember, you can't sell something unless there's a buyer. Okay, but unfortunately, you can buy something when there's no sellers if you borrow all the stock and you create all these fictitious transactions. Okay, so that's the answer to that.
hmm. No, I mean, the thing that really strikes me is that when you're talking about the failures to deliver, and you're saying, okay, that could be like up to they're creating naked synthetic shares to the tune of 50, 100% of the number of shares that exist in a company, and then like no one produces them, so they're basically the, it sounds like the biggest con in the world. And I
Right,
can't,
right,
like, honestly,
right,
I have trouble trying to explain what is happening here to people, because I'll tell them exactly what
right,
you've told me here,
right,
and they maybe not quite as articulately, but they can't believe it. They're like, that can't be right. Like you've
right,
misunderstood
right,
something there.
right.
Like, why do you think this level of fraud essentially is accepted?
Well, let's not go back and call it a fraud right off the
Okay.
bat, okay? Short selling is currently legal. It's currently
Hmm.
legal to sell short, and some people actually think it's a good thing. I don't agree with them, but they think that. And so what's the problem? We need to explain to the SEC why this is so bad and how dangerous it is when it gets to heights like this, okay? And why we need to have a stopgap, a cure in place so that this won't happen. Okay. And but you're right. It's hard for people to believe, partly because it doesn't happen every day. Now we're in a particular period where this is happening like crazy, and I think even some of the regulators are spooked by this, and it's about time. And it's not that hard to understand. You know, actually, I had some real estate transactions. I tried to buy land next to my house one time so I could expand my house. And it turned out that when we did the title search, the owner of the land had sold the land to 5 different people, all banks. And the banks gave him money, gave him a mortgage, which he never bothered to pay, by the way. Okay. But they didn't do their due diligence. They didn't realize that there was only one piece of land there, but it had been mortgaged 5 times. And that's sort of almost precisely what's happening in this current scheme of things, because nobody is keeping track of who the real owner is, you know? And so it's like, same thing. You couldn't sell your cow to 6 different people, because it's a cow and it either shows up or it doesn't. But a security that you let floating around here in limbo and you never pay the piper. That's what's happening here. And so it shouldn't be that hard to understand. But here's the other thing, and why it is hard to understand, is the regulators. They're willfully blind, okay? So when you try to tell them this, their eyes glaze over, their ears stop listening, they start probably singing a song to themselves to eliminate the boredom of having to listen to this, and they think it's all baloney. And so they go, this is just ridiculous. How could such a thing happen? How could you sell, if you have 100 million shares, how could you sell 250 million shares? And they think it's a made-up story. So some are willfully blind, but most of the regulators are the regulated. If you look and you say, well, who's in charge of FINRA, the Financial Industry Regulatory Association? Well, it's the CEOs and the CFOs and, the chief accountants of all of the companies that are being regulated. And the third thing, of course, at the end of every story, there's always, it's the money, stupid. People are making billions of dollars lending these fictitious shares over and over and over again. And many of them are honest and upright people. Some of the biggest villains here are mutual funds. They make significant amounts of money by lending shares into this market, okay? And then they don't want to reclaim them because they want to keep on collecting that money they get every day. So that's the real answer. It's a combination of being willfully deaf, dumb, and blind, being just not wanting to internalize what a mess there is because they're not sure how to untangle it, even though it isn't all that difficult. It'll be difficult for the people who are skimming off all this money, but it won't be difficult for the SEC to fix it if they have a mind to. So that's the real answer, okay? There's a name, they call it regulatory capture. The industry itself, the financial industry, banks, brokers, investment funds, they basically have captured. What does the SEC know? These are kids who come from law school. 80% of them are kids that are a year out of law school. And what the heck do they know about anything? You know what I mean? So it's not that hard to pull the wool over their eyes or to completely flummox them with a barrage of baloney. So that's the answer to that one.
Yeah, and I guess if they try and look into something, they're going to be met with the best team of lawyers that money can buy, as opposed to whatever the SEC has at their disposal.
That's part of it.
Thanks so much for listening. If you enjoyed the show, please subscribe, follow me on Twitter, or sign up to our mailing list. Thanks a lot to our sponsor, ExpressVPN, the #1 most trusted VPN. Get lightning fast connectivity with servers in 160 locations across 94 countries. Keep your browsing privacy safe with ExpressVPN. and get a 35% discount on 12 months of ExpressVPN when you follow the link in the description below. Don't forget my book is now out and available to order on Amazon and on bookshop.org. That's Brexit, the Establishment Civil War. And most importantly, thanks for listening. We'll see you next time.